All right, guys, happy to be here with Jeff Christensen, one of our top advisors, and he's got a pretty cool story. He's going to cover three key points related to kind of the old-fashioned 60-40 allocation rule and an interesting spin on it for today's economic climate, and a quick recap and history lesson that is very powerful as well. So, Jeff, why don't you tell us about the plan?
Yeah, sure. Thanks. So I got in the investment business 26 years ago. And so through that 26 years have certainly seen ups and downs in the US stock market and the economy and the real estate market. And so currently what we're seeing is the US stock market and the real estate market at record highs. And just seeing a high doesn't necessarily indicate that something is overvalued. So then we look at things that are called valuations. And current valuations in the US stock market, depending on the valuations that you're looking at, indicate not just an expensive market or an overbought market, but some of the valuations indicate a more expensive market than there's ever been. And so having that awareness is something that's really, really valuable to people. The Dow in 2009 hit a bottom of 6,500. Here we are, February 2021, and it's gone from 6,500 up to 31,000. And it's done that in the course of 12 years. And the average returns over that period of time are higher than average returns have been. And so there are many institutions now, large institutions, and many experts signaling and making people aware that underlying valuations are very high, and that increases the danger for people to lose money in the U.S. stock market, in the U.S. bond market.
And Jeff, you used an analogy about kind of a doctor and a blood pressure example. Why don't you kind of share how that ties in with some of these indicators we're seeing?
Yeah, sure, yeah. So if you asked most people where the stock market was, maybe they pick up their iPhone and they say, "Oh, I know right here." And they say, "Well, the Nasdaq here. Let's actually take a look, and we'll give you the exact price today." So the Dow Jones today closed at 31,613. So pretty much anybody with an iPhone can just look that up and see in real time what that is. But then if you ask that person, well, what does that mean in terms of valuation? Or is 31,000 high or low based on really what it's worth? So you can liken that to a patient coming into a doctor. Doctor says, "How do you feel?" You say, "Oh, well, I actually feel pretty good." Doctor says, "Well, let's check your vitals. Let's look at your blood pressure. Let's look at your blood panel. Let's look at your oxygen level."
So these are all quantitative indicators or data that can potentially point to the health of a body, or in this case, the health of a market.
Yep, that's exactly right. And so just like a very high blood pressure reading or a very high glucose reading or something of that nature can indicate that that person may have some problems coming, well, just like in the US stock market, if you reach very high valuations, that can certainly indicate that there might be some very big problems coming, although it's impossible to predict exactly when or to what extent. Mm-hmm. Yes, that's exactly right. So there are many institutions and individuals with a great deal of credibility who right now are, Bank of America, for instance, Forbes ran an article, and it was titled, Bank of America declares the death of the 60-40 portfolio. That is a huge statement from an institution like Bank of America. A 60-40 portfolio is where the typical investor, big and small, basically has their money invested, which is 60% in equities or stocks and 40% in fixed income or bonds. And so once your valuations get very high in the 60 part in the stocks and very high in the 40 part, well, then people are stepping back and saying, "Hey, wait a minute, the returns that people have gotten for 10, 20, 30, even 40 years in 60-40 portfolios, they might used to getting a 10% annual rate of return. And many of those institutions and individuals are now saying, absolutely do not expect those kind of returns for the next 10 years.
And you had mentioned the role that alternatives have entered into the world, and can you just describe what that means and what the strategy could involve relating to alternatives?
Yeah, and what an alternative is.
Exactly.
Yeah, sure. So if so let's say you take people and they have a 401k and they need to choose options. Well, typically they're going to choose from stock mutual funds and bond mutual funds. That's typically what those choices are going to be. So when the industry talks about alternative investments, they're talking about alternatives to stocks or bonds. And that can cover an awful lot of ground. And so a lot of these institutions and individuals who are coming out and now saying that you need to rethink the 60-40 portfolio aren't right now necessarily coming to the table with solutions of how you might change that. One solution that I think is going to become enormously popular is what's called a structured investment, where you might have a limit on the amount you can make on the upside, but you may have a floor or the maximum that you could lose on the downside. So let's say, for instance, you invested money and you could make up to 8%, but if things went down, your floor was 0. So you might have a range there of 0 to 8%, or maybe a -7 up to a positive 28. Okay, so people can kind of choose. Those are called structured investments. Wall Street builds those, and U.S. life insurance companies build those. And frankly, major U.S. life insurance companies that most everybody has heard of got ahead of the curve. I don't know if they did that on purpose or not, but they did. They got ahead of the curve, and they've now built those types of investments that you could build into a 60-40 portfolio. And you might then call that a 30-20-50 portfolio.
Yeah, and on that vein, you had said, hey, we kind of take conventional wisdom of a 60-40, and I think you used the terminology, let's chop that in half, and that exposes a void, a good void for an alternative vehicle. So
yes,
you mentioned the 30-20, so 60 goes to 30, but talk through that a little more.
Yeah, right. So these institutions and these individuals, and what I'm saying right now is not saying that people shouldn't still be diversified. I'm not saying they shouldn't own stocks. I'm not saying they shouldn't own fixed income. I'm saying that you need to be aware and then perhaps reduce that 60-40, cut it in half. So you now maybe have 30% in stocks instead of 60, and maybe 20% in bonds instead of 40, and now that leaves 50.
Yeah.
That leaves 50, and now perhaps you're adding things like structured investment. In the life insurance world, they've now built those for both large investors and small investors. And they're able to do that in a variety of forms. One, believe it or not, is in a life insurance policy, and another is in something that's called a deferred annuity, and it can be done both qualified and non-qualified.
And touch on how the banks are using these. I mean, this isn't anything new to them. They've seen the writing on the wall with this for the last 50 years.
Sure, yeah. It's really interesting. Banks invest their own money, not their depositors' money, but the bank's own money into these type of life insurance products and investments. I recently saw a really interesting report. So we in the industry know that these banks own something called BOLI, which stands for bank-owned life insurance. And that's an investment and insurance hybrid tool that they use. I recently saw from two of the biggest banks in the country, they owned $20 billion in that type of asset, and that bank only owned $8 billion in real estate. So I wasn't surprised to learn that they had $20 billion in those life insurance investments, because we already knew that, but I was surprised that number was more than double even of what they had in real estate holdings. So these are very grown-up investments. These are institutional in nature, and a friend of mine in the industry calls it an asymmetric asset, as opposed to a symmetric asset. A symmetric asset, you can only make money if it goes up. So if the stocks go up, that's how you make money. If the bonds go up in price and yield, that's how you make money. Well, what if those things are going sideways or down? With an asymmetric asset, you have the opportunity to make money from volatility, markets going up and down, instead of markets just going up, because that song might be over for a while, and there's absolutely no way to tell. But what's important is the awareness. That's what's important.
And this notion of making money in volatility, especially with that structured type product. So I've heard the term lost decade, but if you can just touch on like what history may teach us about the future.
Yeah, sure. That's a great question. If you invested $1 million in January of 2000, and this comes as a real shock to most people, even people that live through it. If you invested $1 million in the S&P 500 in January 2000, over the next 10 years, by 2010, you actually had a bit less than $1 million. Well, it didn't grow from $1 million to $950,000 in a straight line. It first went like this. And so markets never move in a linear fashion. They always move in some type of an up and down fashion. And so in that lost decade, people refer to 2000 and 2010 as the lost decade, meaning, hey, if I invested money in 2000, 10 years later I came back for the money, I didn't make anything. In fact, a crazy fact, if you had $1 million in the NASDAQ, which is companies like Microsoft, Amazon, Facebook, Netflix, Google, companies like that, if you had $1 million there in January 2000, you lost 77% of your money in 2 to 3 years going down. You didn't get back to even for 16 years. 16 years.
So that everyone talks about stay invested in that recovery, and that usually holds true, but the question becomes, how long does it take? And God forbid you retire in there, it takes a long recovery time. And I think one of the things that we talk about is this notion of this annual reset in some of these newer products that could be built into this, where volatility in that same 10-year period, if I put, a 10% cap and a 0% floor, and I miss all the negative years, I could actually get a 4 to 5% compounded average rate of return in the quote unquote lost decade. That's a total return of, call it up 50 versus down 5 or 10% if I just stay invested.
Yeah, and that asymmetrical alternative investment during the last decade did 5% on average. I mean, that's
Basically by missing losses.
Correct.
And capturing only a part of the upside. When you get from A to Z in that 10-year period, you were up about 5%.
Right. That's exactly right. And investors want to know this information, and they typically, you know what you know, and you know what you don't know, and then there's this giant space where you don't know what you don't know. And what I find in talking with people and investors is this now starts to get into what they don't know what they don't know. And I think it's partly because it may be counterintuitive to go to a life insurance company to find an investment or even a superior investment or an alternative investment. So people in the life insurance industry understand that, but I don't know that the general public necessarily thinks of that because it falls under you don't know what you don't know.
And the running joke we were joking about, what's the grade that insurance companies get for their marketing efforts and commercials and all that?
Well, I don't know if the insurance industry is going to like me saying this, but I would give them an A in product design for investors.
And risk management.
And risk management. They're the best risk managers in the history of the world.
That's what they do. Yeah.
It's what they do. They also have tax benefits for investors that the banks and Wall Street firms don't get. They get special tax benefits for investors that banks and Wall Street firms don't get. It's a big deal. So I don't know if the life insurance industry is going to like or not like what I'm saying, but I believe it to be true. I give them an A in those product designs and those investment designs, and maybe a D or even a D minus in public relations or marketing. Because it's just counterintuitive to many people at first to think that they might go to an insurance company to build something into their investment portfolio. Just as counterintuitive as it might be, why would somebody go to an investment firm to get insurance? That might be counterintuitive too, right? But here we are in 2021, and you can go to an investment firm and get some amazing insurance. And you can go to an insurance company and get some amazing investments. So it really does go both ways.
Yeah, no, I agree. And I think that's the name of the game, some of those tax advantages. And you kind of have to think to yourself, maybe these carriers realize they have a good thing and they don't want to kind of exploit it or drive a truck through it, so to speak. That's another interesting thought that they kind of keep in their lane, so to speak.
Yeah, I've also found it to be a little bit cultural, in that most of the people that are running the big insurance companies, think about it. Who's the president of a major insurance company? Well, it's the guy who started there 40 years ago as an intern. And so culturally, he or she is an insurance person. And the person who's the president of a big Wall Street firm who's 60 years old, well, where was he when he was 20? He was an intern at that Wall Street firm. And so culturally, he's an investment person. And so what's happened over the years is the insurance companies, who are huge owners and huge investors in bonds, corporate bonds, high-grade commercial real estate, they are really institutional big boys in the investment world. And they have also recruited a great deal of talent from Wall Street to be able to build these investment designs within the parameters of those different types of insurance products. But I don't think, I'm probably going to get some people mad at me at insurance companies, I really don't think that they've done a great job in conveying that message to investors. Average investors, small investors, big investors, even institutional investors. And the three of us know that because we see that over and over and over, where we're going in and we're talking to somebody and we're showing them or we're educating them, and they basically say to us, I don't understand. I don't necessarily understand why you're talking to me about this. And then at some point it clicks and they do understand.
Absolutely. So it's definitely a change, a way of thinking for the financial advisors and the clients. So we'd love to share more about this strategy with you. Give us a call or shoot us an email and we'll be in touch.